Hi friends, good to see you again all. I hope you all will be fine. And for all of you, I pray that God fulfill all your dreams and give you lots of happiness. And my dear friends, every time I try my best to give you all latest news. Therefore you are requested to sit tight on your seats and enjoy the latest news. How to become a millionaire by investing. Investing can help you reach the $1 million mark if you start early, stay in the market and follow other key principles. Not everyone can win a lottery, inherit wealth or build a successful business. But there is another tried and true way for ordinary people to build wealth without depending on luck, inheritance or the ability to build a business empire. It's called investing. Investing does not automatically lead to wealth. Putting money in the stock market, for example, will not make you a millionaire, just as randomly tapping your keyboard will not make you a great writer. Surely, you've heard of people or seen them yourself who invested in the stock market hoping to be the next Warren Buffett, but who ended up losing money. Many of these people had lofty aims but lacked the principles needed to achieve them via investing. Consequently, a good place to begin is to identify the 4 principles of successful investing. Principles of successful investing. 1. Start early. To make this point clear, let's consider the benefits of compounding. Albert Einstein once called compounding the 8th wonder of the world. When you consider the way compound growth helps with building wealth, he is right. With compounding, all the money you invest earns interest while the resulting interest also continues to earn interest. For example, if you invest $1,000 at 10% yearly compound interest, then you will earn $100 at the end of year 1. At the end of year 2, both the original $1,000 and the $100 interest will earn compound interest. A year later, the initial $1,000, the $100 earned at the end of year 1, the $100 earned at the end of year 2 on the initial $1,000, and the $10 earned in year 2 on the $100 interest earned at the end of year 1 will all earn compound interest. And this process goes on for as long as you want. Given the benefits of compounding, it is always better to start investing early rather than later. The earlier you start, the more you can benefit from compounding. To understand this better, consider 2 investors, James and Jane. James started investing at the start of 2020, while Jane began in 2022. They both invested $1,000 at 10% compound interest compounding yearly. At the end of 2023, James would have $1,464, while Jane would have $1,210, a $254 difference. However, as long as both keep investing at the same compound interest and for the same period, that 2-year advantage would persist and even expand going forward. By the end of 2029, James would have $2,594, while Jane would have $2,144, a $450 difference. The difference keeps expanding because the longer you stay in the market, the more compound growth you can earn. Many of those who end up losing money in the market are those who are controlled by what Warren Buffett calls the fear and greed cycle. These people invest in the market because they heard that people are making money from one investment, greed. But by the time they enter, the market is already frothy and the values of their investments decline. They then sell out of fear of losing it all. In the end, they have bought high and sold low, thereby losing money. It is those who stay in the market, through its highs and lows, who can benefit from compound growth. Research has shown that the market rises more than it falls, and that the longer one stays in the market, the higher the probability of making money and the lower the probability of losing it. Over the past 94 years, bear markets took place in 21.4 of those years, according to Hartford Funds. That means stocks have been on the rise 77.2% of the time. 3. Invest consistently. While investing a lump sum in the market and staying in the market can lead to healthy returns, there is an even better way: investing consistently. Consider two investors who started with $100,000 in the market, earning 10% interest that compounds quarterly. Mike does not add to his investment, while Mary adds $1,000 at the end of every month. At the end of 5 years, Mike would have $163,862. On the other hand, Mary would have $240,496. Though Mary only invested an additional $60,000, $1,000 per month for 5 years, she is $76,634 richer than Mike, making $16,634 from the compound interest generated by that extra $1,000 monthly investment. The point here is that the fastest way to build wealth is to invest a certain amount regularly. Thus, when creating your budget, you should set aside a percentage of your income to invest consistently. 4. Diversify your investments. Many people have lost significant amounts of money in pursuit of the next big thing in the financial markets. Successful investing requires diversification. This means, for example, investing in multiple stocks in different industries instead of just 1 or 2 stocks in the same industry. It can also mean investing in stocks as well as bonds. Less than speak greater than. Since diversification can be hard to achieve for retail investors, many investment professionals, including Buffett, have advised that they stick to investing in the S&P 500 index. Less than speak greater than. By investing in this index, investors have exposure to 500 solid companies. Some retail investors have also sought to diversify by buying index funds or exchange-traded funds, or ETFs, that cover emerging markets and small-cap stocks, among others. Many investors also include a certain percentage of bonds in their portfolios to minimize risk. Whatever the method used, the key point is that diversification can help reduce risk and prevent huge losses in the market. Bottom line: investing in the stock market remains one of the most tangible ways to become a millionaire. It is available to everyone, and it does not require luck, a rich family background, or entrepreneurial genius. The only differentiating factor is the number of years it takes every individual to get to those $1 million. Nevertheless, as we have seen, there are principles that you must embrace. Following them is not a matter of intellect but emotional discipline, as Buffett has always emphasized. Consequently, becoming a millionaire is only hard because of the fear and greed cycle and the lack of emotional discipline that subject investors to the short-term whims of the market. If you can start as early as possible, stay in the market through the highs and lows, invest monthly and diversify, you can be on your way to becoming a millionaire. Forget the lottery, forget inheritance, forget business genius, forget who wants to be a millionaire. Investing, when done right, is a sure path to wealth. As always, do your research before you decide to invest. Never invest more than you can afford to lose. Thanks. Take care.